Good afternoon. It's Jeffrey Christian of CPM Group. It's about 12:25 on Tuesday afternoon, the 26th of September here in New York. In line with my New Year's resolution I made that I wanted to have shorter videos and videos that were focused on the real precious metals markets as opposed to all the detritus that you see on the internet about conspiracy theories and manipulation and stuff that people just don't know, but don't worry, the price is going to $20,000. Last January, I made that resolution. I'm going to try again to be short and to be focused on the real gold market. And one of the things that's going on in the real gold market is that demand is pretty strong. It's pretty strong in many parts of the world. Indian demand's a little bit weak. Demand in the Middle East, a lot of which feeds through Turkey, has been relatively strong. And Chinese gold demand has been strong too. We're seeing the Chinese demand in this rise in the price in China, the local Chinese gold price relative to the London price. People will talk about the premium of Chinese gold prices to London or the Indian gold price to London. And I'll talk about the premium a little bit later because I think that that's a term that carries connotations that are not accurate. But you can see here, this goes back to 2015. There typically is the price local Shanghai tends to be higher than the price in London. And that makes sense for a variety of reasons. China is the largest producer, perhaps the largest refiner of gold, one of the two largest markets for gold. There is a lot of demand for gold. It is a communist country with certain controls, including import and export restrictions, and a managed economy. There are a variety of reasons why it makes sense that gold prices should be consistently somewhat higher in China and in the Shanghai market than in London. So all of those factors are in there, and you can see over time, gold tends to be at a premium in China and in Shanghai specifically. That's where this price is, and that's a very important point to note that I'll get back to. There was a drop during the pandemic, and there have been spikes down during the Chinese zero COVID policy. But the real key is that the premium, if you will, of prices for gold in Shanghai relative to London have shot up sharply really since June and July. My next chart actually, apologize for the amateurishness, I did it myself, kind of just shows you this year. And you can see it really started in July slowly, but then in August it shot up much more sharply, shot up sharply in September. It came off last week. And there have been all kinds of questions that we've gotten from clients about, well, what's going on here? Why is the price in China sharply higher now relative to where it was? And then after last week, why has the price differential come down? There's several things, and I've got notes, so excuse me if I look over at them to make sure that I cover all of the salient points. First point I want to make is you have to understand the difference between China and the Chinese government and the People's Bank of China. China is a big country, 1.4 billion people or so, and many people buy and sell gold in China, and they don't necessarily take their cues off of the Chinese government and the People's Bank of China. And there are people who don't understand that, and I've seen this my entire career. When I first started in the precious metals markets back in the late 70s, the bugaboo that people used was the Middle East. Why is the gold price high? Oh, the Middle East is buying. Well, who are you going to call in the Middle East to verify that? Or the price is falling. Oh, well, it's the Middle East. For a while, it was the Soviet Union. Hello, may I speak to the Soviet Union? Are you buying gold? And sometimes it's India, sometimes it's China. People like to think in very simplistic terms about complex markets. And there are a lot of people in China who buy and sell gold. And we saw this last year. there was about a 4 million ounce decline in gold demand on an annual average basis in China last year. People bought less gold and jewelry. People bought fewer pieces of gold investment products. And there was actually a considerable amount of selling. You were during the zero COVID lockdown period within China, and economic conditions were strained. We saw demand from individuals and companies, jewelry manufacturers, retailers, and wholesalers of investment products start to pick up in December of last year. And it has done better. Our projection as of September is that you might see about 2.5 million ounces increase in jewelry and investment and other private sector demand for gold within China. So you are starting to recover from the low that you saw in 2022, the spike down in demand, but it's probably not, as high as it was in 2021. In addition to that, the People's Bank of China has started purchasing gold again. It had been buying a lot of gold up until the middle of 2019 at prices between $1,200 and $1,350. When the price got over $1,350 in July of 2019, the People's Bank of China stopped buying. And they didn't buy when it got to 16 or 18 or 2,000. But when it got back down to 1624 last November, it bought 1 million ounces of gold, and then it bought another 1 million ounces of gold in December. And so far through July, the most recent time for which we have data, they have bought about 4 million ounces. So there's about a 6 million ounce increase in the People's Bank of China's gold reserves and in demand for gold by the People's Bank of China. And the People's Bank of China tends to buy in the Chinese market. That's where the liquidity is. As I said, major producer, major refiner, major consumer, major investor in gold. So it's very important to understand People's Bank of China is an important player in the gold market, but it's not the sole player in the gold market. And China is not Chinese government. And oftentimes people in China do things on their own, sort of like personal freedom type of thing. Second thing is, okay, so you have that. And we look at this premium and we say, why has the premium risen? Well, the primary factor was a rise in private sector demand. You had a very weak demand from April through November into December last year. And there is some pent-up demand, which we're starting to see over the course of the first 8-9 months of this year. So the primary factor is that increased demand. The secondary factor is that the yuan has been weak relative to the dollar. And you also have come out of the zero COVID lockdown period, and Chinese economy and economic activity are recovering. And then there's another thing which you need to pay attention to. The price that we queue off of is the Shanghai Gold Exchange. And the Shanghai Gold Exchange is a professional market. It's not like the COMEX or other markets where you have a large retail presence. You have thousands of individuals trading gold on the COMEX futures and options exchange. Individuals as well as institutional investors, individuals buying and selling gold and silver on the COMEX. You don't have that in the Shanghai Exchange. Shanghai Exchange primarily is for professional participants. So mining companies, smelters, refiners, industrial users, wholesalers, banks, and trading companies that buy gold to provide to jewelers or to have made it into investment products. And so it's a different type of market than you see in New York or even in London. Yeah, that's another factor. I want to stop there and talk a little bit about premiums. People use the term premiums and they talk about oh, well, there's a premium in China or a premium in India or a premium in New York relative to London. And in one sense of the term premium, that's true. But it gives the connotation that those markets trade off of London. There's an arbitrage that goes around the world. And when you see dislocations in prices between New York and Hong Kong, or New York and Shanghai, or London and Shanghai, or London and New York, or London and Mumbai, you will see people trade that arbitrage, which tends to keep the price relatively close to itself. But it's not like the prices in each of those markets is determined by the London price plus or minus a premium or minus a discount. These are independent markets, and the prices are set nationally or locally in each market. So you have to be careful when you start talking about the premiums in this market or that market, because it's not that is how the price is determined. The price is determined on a global basis, on an ongoing intraday basis, virtually 24 hours a day. And it's determined in each market relative to the conditions in that market. Now, going back to the premium in London or in Shanghai, we have seen this spike higher. It was a reflection of increased private sector demand for gold, for jewelry, and for investment products. There was a factor in there that there was concern among consumers and individuals and banks and others and corporations about the weakness of the yuan relative to the dollar. So there was shifting of assets into gold. In August, the People's Bank of China tried to quell that, and they did it by imposing what they called a temporary moratorium on gold imports by smaller banks and by provincial banks into the market. And what happened was that further constrained supply relative to demand. And so you saw this very sharp increase, which is visible on this chart, in August, and then again in September. The premium went from $10 an ounce to $60 an ounce to $120 an ounce. So last Friday, the People's Bank of China suspended that temporary moratorium and released those restrictions on imports. You saw the premium immediately come down from $120 to about $70, and it's been trading, $70 to $90 over London in the last couple days as a result of that. So the premium, the existence of the premium, reflects individual, private sector demand for gold in China. And then the spike that we saw over the last couple months reflected that PBOC policy to some extent. Interestingly, the policy has been suspended, but the premium hasn't gone back to $10 or even $20 an ounce the way it was in July. It's staying up there because there is still a perception of economic issues that need to be dealt with, and the demand in China for physical gold by investors and in the form of investment products and in the form of jewelry remains strong. Gone longer than I wanted to, but at least I've been substantive and talked about the real gold market in this video. I hope you enjoyed it. You can go to our website. You can get other free videos and free reports. You can buy our yearbooks. You can read about our retail investor programs and other services that we provide. You can send us a note at info@cpmgroup.com about things that we might be able to do to help you better manage your exposure, your price exposure to the prices of gold, silver, and other commodities. Take care of yourself and those around you. We'll speak to you Friday, and hopefully I will have done something better for the world in the intervening 3 days, and so will you. Take care.